Well, welcome to you all from wherever you're watching. We're thrilled to have this chance to chat about smart giving. We put this panel together at the request of some of our donors to learn more about really effective giving. The tax, legal, charity, and family components are often overwhelming, and we hope this will help you unravel some of them. Before I introduce our experts, I want to note that we're recording this session so that we can send it to you afterwards with a summary of key points, slides, and a few helpful notes and links. You will notice at the bottom of your screen, there's a Q&A option. Please feel free to type your questions in that box at any point during the presentation. Toward the end of the webinar, we'll have a chance to pose some of the questions to our experts. It's my absolute pleasure to introduce our four specialists, after which I'll provide some research on the psychological benefits of giving before they present the details to you. We're truly touched that each of these talented individuals has donated their time to share with us the benefits of their experience and knowledge. So I introduce Patricia McDougall, our tax expert with Deloitte, who's joining us from Toronto. Brent Vandermeer, our financial investment expert with Crosspoint and our Help Lesotho golf sponsor, is joining us from Ottawa. Jennifer Stebbing, our expert in charity law, legacy gifts, and wills with Macintosh and Peace, joins us from Brantford. And unfortunately, Lucas Matheson is unable to be with us tonight, and we're thrilled that Vianney Jones, a wealth advisor with Como Capital from Atlanta, Georgia, who was born and raised in Lesotho, was able to join us on cryptocurrency. Dumelame. Winston Churchill said, "We make a living out of what we get, but we make a life out of what we give." I'm delighted to share this session, begin this session with some happy news. The fact is, there are millions of people around the world doing wonderful things to make the world a better place, and you're among them. There's lots of reasons to be optimistic, but perhaps now we have to just look a little harder. As head of a charity, my life is filled with people who give, and I can tell you they're very special. People who live a life of giving are different. Their spirits are bigger, more open. Their lives are more contented. Their hearts notice those around them. People who are generous with their time, energy, and resources. They make us proud to know them. Excuse me. Most people who donate to Help Lesotho come from a familial, faith-based, or philosophical belief excuse me, that it's essential to help others, even those they don't know, will never meet, or from whom they will get no thanks. These people often volunteer in their community, contribute to their organizations or initiatives, and have hearts of gold. There is indeed a type of person, one who gives, one who cares, one who does something about it. Help Lesotho has been working on building resilience and improving mental health for almost 20 years in Lesotho. You all know that. What may or may not surprise you is that our donors' mental health may be benefiting as well. Research findings are consistent. Regardless of the amount or type of giving, whether volunteering, donating, advocating, random acts of kindness to a loved one or a stranger. And interestingly, the benefits of giving are the same, whether the motivation comes from self-interest, faith, ideals, conscience, or upbringing. The act of giving has been shown to reduce blood pressure and stress, which in turn promotes better health and a longer life. Giving makes you feel happy, reduces depression, anxiety, feelings of helplessness or hopelessness. It increases our feelings of well-being and self-esteem. It provides a sense of purpose and gratitude. When we give, our brains release hormones that foster tranquility and a sense of peace. When we buy or do something for someone else, the pleasure sensation lasts longer than if we buy or do for ourselves. And the more and more often we give, the longer the positive effects last. Surprisingly, the benefits begin even before the action. Just thinking about being generous makes people feel better. Smile more. Giving promotes social connection. When you give to others, your generosity often continues down the line to someone else or is returned to you. This strengthens our ties to each other. As we age, we progressively value kindness and generosity. We like the takers less and the givers more. These are the people we respect and look up to, who touch us deeply. Givers tend to hang around together. They support each other, are there for each other when things go wrong. There's a mutual respect and appreciation that adds hugely to life. Excuse me, I'm going to have to take a drink. Giving is contagious. When one person gives, it inspires others to do the same. It acts as role modeling for family members, especially children and grandchildren, and has a positive influence on our friends who admire us for doing it. Giving inspires us to be better people. Even small acts of kindness touch us deeply, and we tend to go over and over them in our minds, don't we? It's the ripple effect. On the corporate level, companies with strong corporate social responsibility programs have better morale, are more efficient, have better public image, and a higher employee loyalty. These are remarkable returns on an investment. In the end, giving is a way we create and participate in community, a sense of belonging, of feeling connected with something outside of ourselves. It helps us to feel needed. Giving makes us better, more appreciated and appreciative people. Giving is the best investment in our lives. It has one of the highest returns you could ever receive. It's the fastest and easiest way to change our lives, to build a kind, supportive network, to believe in ourselves, and to change the world. So let's look at some of the smart giving tips from our panelists. Patricia, would you like to start us off on the tax implications of giving?
Hello there, certainly. Thanks, Peg. Hi, everyone. Thank you for inviting me into your homes. Oh, sorry, I am here to speak to you about the tax considerations of charitable giving. I am an accountant. I love to plan, and I believe that you should planning is also involved in your charitable giving. That way you can take advantage of some of the very considerable generous tax incentives that Canada offers. Oops, I'm sorry, that's too far. So how do we start our planning? Basically, you begin by looking at where is the tax liability. That will determine who is the donor. And by that, I mean three basic taxpayers: the individual. The individual's estate, because the CRA treats those as two different taxpayers. And also, perhaps you own shares in a private corporation. That entity can also give a donation. Next, we would consider what is the property to be donated, because the property you donate can have different tax implications. And finally, when will the donation occur? You can donate currently. You probably have a plan whereby you want to donate during your lifetime and perhaps leave a bigger bequest in your will. Some of the little tax facts for you to take away. There is a limitation, though very generous, to the amount of donation that can be claimed in a year. It's limited to 75% of your net income. That's for all three taxpayers: individual, corporation, and graduated rate estate. The exception to that is on death. That in the final year, you can claim up to 100% of the net income in donations. I just want to draw your attention to the fact that graduated rate estates, or let me just say estates, have special tax rules whereby the donation made by your estate can be carried back to your final return. However, there's certain conditions that have to be met in order to allow for that flexibility. If those conditions aren't met, the donation will have to be claimed by your estate. So what types of gifts? These lists just gives a list of some things you want to consider as current gifts. By that I mean during your lifetime, and deferred gifts as part of your will and estate planning. Generally, we all know cash is quite easy is the standard donation. There's also gifts in kind. And when we consider gifts in kind, I just want to draw your attention to how they are taxed. So just generally speaking, gifts in kind are, you receive a donation slip for the fair market value of the property donated. But in turn, to the extent that that property has an appreciated value over the cost base, you could have a taxable event, a capital gain on your return at the time of the donation. So you get a donation for the fair market value, but there might be an offsetting tax consequence. Interestingly, the CRA or the tax regulations provide for a method where you can elect somewhere between the cost base and the fair market value if you do not want to incur the full fair market value gain, but your donation slip will be adjusted accordingly to match the elected amount. Gifts in kind, there is a wonderful tax incentive, which is an exception to the fair market value income inclusion rule that I just mentioned, and that is the donation of publicly traded securities. Publicly traded securities, any gain that you accrue on the donation, you realize on the donation of the publicly traded security to the charity, is exempt from tax. That's amazing, but you still get the donation for the fair market value. It's delicious. And it's used quite frequently, but there's just a few things I want to point out to you. Do not, under any circumstances, sell those securities on your own and donate the cash. No, you're outside the rule then. In fact, the securities have to be donated to the charity. And you can work with your advisor, I'm sure, and the charity to make sure that transition is done. Now, to maximize the benefit of this incentive, you'd want to select your security that had the most appreciated gain. And by that, I mean the greatest difference between the cost base and the fair market value. Oh, and lastly, it can't be a donation in your registered plan. You must own it personally, your estate must own it outright, or the corporation. Let me just touch on the rules of what I was talking about, the special rules of the estate making the donation. Again, this special rule is, I'm going to call it the flexible rule, whereby we would like the donation in your estate to be carried back to your final return. It's very critical to fall within those rules if you want to get into that carryback. Otherwise, the donation has to be claimed by your estate. And that might not be where the tax is. So the rules are such that the property that is donated must have been received by the estate at the time of death as a consequence of the death, or substituted therefor. And what I mean by that is If you sold the property and the estate sells the property and you gets the cash, you can make the donation. But if you have to borrow to make the donation, then you are the donation will not apply, and you can't be into these rules. So it's very, you have to consider how that gift will be funded as part of your charitable gift planning. So I would suggest that you want to maximize your benefit, take time to reflect on what you want to achieve with your charitable giving, develop your gift plan, and think about the tax incentives. What is this tax liability you want to eliminate? Who's the donor? Look at some interesting ways to donate different property, not just cash. And when will this donation occur? Run some numbers, use your advisors, tell them you have these plans, and go ahead and implement these plans. I've recommended at the bottom of on this slide a CRA document, and when you receive the package, I believe this is going to be in a link to my presentation. Thank you very much.
Thanks so much, Patricia. I love the way you unpack those issues.
Thank you.
And Brent, I'm sure you want to expand and on some of the things that Patricia raised and help us with some more financial planning. Over to you.
Sure. Thank you, Peg, and thank you for letting me be here today. It's a real honor. Just seeing if I can advance the slides here. Okay, there we go. I have control. So I'm going to go over just a few things today, both from a financial planning perspective and then some practical things about how to donate shares, because that's a very common method, as we just heard. But there's a lot going on, as you are well aware. It's been a very interesting start to the year, and some of the things like the rising inflation rates around the world causing interest rates to rise has certainly caused a change in the climate in which we feel, both in housing prices and stock market prices, and the looming threat of an economic slowdown. And so these things can sometimes affect how we give and when we give. And what I wanted to share today is more around how important it is to have a financial plan in place that you're aware of and that you keep up to date. Because if you don't have that financial plan in place, you really won't know clearly what excess there is that you could give. And so a financial plan is your roadmap. It tells you where you are now, and it tells you where you'd like to go, or you decide where you want to go. And then the plan tells you how you're going to get there. And I think that plan has to adapt over time. For people who are in the building phase of their lives, that plan looks very different when you're starting out your own financial life. You may be married and buy a home for the first time, maybe have kids, start a business. Well, a plan looks very different at that phase. It needs to evolve and change as life goes on. In your middle life, you may be buying a cottage, or a marriage breakdown occurs, you leave a job, you deal with aging parents, all sorts of things like that have significant impacts and require changes to your plan. The latter part of one's life is more about extending that wealth. And in your elder years, you may be thinking about ceasing your work and becoming financially independent. You might be transferring a business to either your heirs or selling it to a third party. Disabilities may occur, but then more interestingly too, you can have some interesting planning work done around what kind of legacy you might want to leave. And so that plan has to change. And we work with our clients over those phases to try to define things in these buckets. I like to think of it as filling up this first bucket is about what are the most important immediate things that we have to do. And that's different for everybody, but it can commonly be to set up an emergency fund, or pay off debt, or help fund children's or grandchildren's education. It's important to quantify what amount of money has to go into that bucket. And when it's full, that bucket can overflow into the next one, which typically is how can I become independent from an income point of view, and how much is that? If one is blessed with a defined benefit pension plan, that work is all done for you. But if you don't have one, it's important to do the same kind of work where you define how much money you need to have set aside to supply a certain amount of income, the lifestyle that you want, over what period of time, and at what rates of return and inflation rates and all of that. When you realize when you quantify and come to the conclusion of how much money that is, you'll know how much has to be in that bucket. For those in the accumulation phase, you then set a plan for how long it takes to fill that bucket. When you filled it, we go on to this third bucket, which we like to refer to as an abundance plan. And that can be things of concepts around estate planning and legacy planning. It can also, though, be while you're still working, how or quantify for you how much you might be able to give away without impacting that second bucket. And that's a really interesting one that, again, we can quantify if we do that financial planning work. And as time goes on, this type of chart is something that we use with our clients to tell if we're actually funded in each of those buckets. For some people, this is a chart of an accumulating phase where someone's building up assets, and it can tell us each year how we're doing. So when markets are difficult like this, you may actually still be overfunded in your plan. You'd only know it if you had a tracking tool to compare the actual with the plan. Similarly, if you were in a decumulation phase and the chart was trending downward as you were using your capital, you still might clearly see if you have excess capital over your needs. And that's a really fun thing to work with our clients on, because we can tell them you have enough and you can give, and we can give that peace of mind around that to know that they can give freely. And so that part of the planning is a really exciting one. And just quickly, I wanted to touch on, I don't expect you to actually see the numbers on this slide. It's just to give you an idea that an estate planning or a legacy planning work is very important to spend the time to quantify where does the money actually go in your estate. What does your will truly say? What beneficiaries do you have on various plans? We like to map it out with the help of—
I'm sorry, I'm busy.
With the help of our clients, lawyers, and accountants to map it out. Often people are surprised. And this is just a quick case, a little snapshot of a client of ours who was trying to give money to their favorite niece who really invested in their life and did a lot. And I remember sitting in the meeting with this client, and she said, yeah, I want to give $125,000 to this niece. And I remember thinking, my goodness, that's not the way it's going to work out at all. And so I spent some time to map it out in a spreadsheet. And what ended up happening is that the 12 cousins who were named as the residual in the will were going to get 3 times almost as much money as the favorite niece was going to get. And the client's jaw dropped. She didn't realize how much wealth she had built over the years. And the point of the story is basically put it down on paper and see where it actually goes. And so the idea here is, just to go back to giving shares, it's been talked about, so I'll go quickly over this, but you can donate shares in kind, and brokers like us, investment firms, can receive those shares. Again, they cannot be sold by you. They can't be cash. You can give the shares directly, and in kind, avoids the capital gains tax. And this chart just shows you the economic benefit of that. Not only do you get the charitable contribution here for the credit, but you save the capital gains tax. And the point is, you basically can give upwards of 20 to 25% more than you would if you gave cash. So giving shares is a wonderful planning tool. But today, in this risky market, people are often wondering, can I still give? And are my shares down in value? And so it's important to look at that plan and say, do I have excess capital? If I still do, then I think you can still move forward with your giving plans. So that wraps up what I was going to say today. Thank you so much for having me here. I think you're on mute, Peg.
Sorry, technical issue. Thank you, Brent. Your way of describing some of those options is really helpful to me, and I'm sure to our listeners. It leads us to the legal aspects of some of these opportunities to give, which Jennifer will walk us through on a fairly general level. Over to you, Jennifer.
Thanks, Peg. Right, I'm Jennifer Stebbing. I'm going to be talking to you about legacy giving and wills. Just as a disclaimer, I'm a lawyer licensed in Ontario, so I do have an Ontario slant on most of what I am saying, and that I'm not giving you legal advice tonight, but I am giving you information, and you can feel free to reach out if you want any more particulars. What I'm going to talk about is charitable giving in a will, which is going to look at legacy giving. What is it? Myths about legacy giving. What is a will, and how do you leave money to a charity in a will, either a fixed amount, percentage, and how that works? And how do you leave money to a charity outside of a will? So a donation can be made by an individual through a will or other formal designation, and that's what legacy giving is. It's also known as planned giving, and I think if you're going to remember one word that you're going to hear all of us say tonight is the word plan. The point is to have a plan to make sure you know what you're doing so that you can be tax efficient, and you can save as much as you want for your beneficiaries and as much as you want for your charity. So it's really just making sure that you have that plan and use your advisors to their utmost. So some myths about legacy giving. Some people are concerned that they want to support their favorite cause, but they also want to support their loved ones. There's a lot of people that think or that have a personal belief that their estate, 100% of it should go to their family or their loved ones or something like that. And it doesn't always mean that you're taking something away from a beneficiary to be able to give to a charity, because as you've heard, there are some great tax incentives to be able to donate to charities. And so you might find out that you're actually only losing a very small bit of your estate to give something really big to a charity. Some people think I'm not wealthy enough to leave a gift to a charity. I can tell you from all the charitable boards I've worked on, the charities I've worked with, this $5, it makes someone just as happy as 5,000 and going up to 5 million or even more than that. No gift is too small for a charity. They've always got something they can do with it. And every charity is always looking for their next gift. So people think it's too complicated. It's not, don't worry about it. You have great advisors in your corner. They can make it simple for you. I know when I deal with people when they want to give to charities, I ask them to tell me very simply what they want. I might make it look complicated, but it's not. It's just going to say it in the legal words we need to make sure that what happens with your money is what you want to happen with it. Some people say to me, well, I already have a will. I don't want to do another one. Well, you can do an amendment to a will. It's called a codicil. Not hard to do, pretty quick to do. Or you can update your will when you normally do during your lifetime. You need to update when your kids get old enough, or maybe there's been a divorce or a birth or a death. So you can always update it at any point in time for those things. And then some people say, I'll be gone, so I'll not see the impact of my gift. Well, you can give during your lifetime so that you can see it if you want to, and then you don't have to worry about it. But it's also realizing that depending who you're giving to, you could be having a massive impact for your children, grandchildren, great-grandchildren, great-great-great-grandchildren they haven't even met yet. So it's knowing that you're giving ahead for that and that you leave that legacy behind. So what is a will? It's a written document setting out your wishes after death. It has to be a document of some kind. It has to be written. So there's no, you can't do a video or you can't do a voicemail. You can't do things like that. It must be written down somehow. It's either not in your own handwriting or in your own handwriting. So a usual typed up will, that's what we usually see. But there is a will called a holographic will that you can do in your own handwriting. I kind of say you use that in emergency situations where you just need to write something down because something's happened, and you write it in your handwriting and then you pass. If you can get it done properly, because there's all sorts of requirements to have a will being valid, and the right advisor is going to be able to make sure that you do all of those things. So your will appoints your executor or your estate trustee. That's the person in charge of doing everything you say in the will and making sure that the estate pays the taxes and its debts and everything's wound up. Your will provides for the payment of any of your debts and your taxes. It can set out any specific gifts, and then it sets out who receives what portion of the remainder of the estate, which is also called your residue. So there's different ways you can benefit a charity in a will. You can do it by a fixed amount. So you say $10,000, $5,000. You can also say a specific asset. So my shares in CP, or my house, or my car, or this bank account, and you give the bank account number. My only caveat when you're doing something like that, like a specific asset, is you need to think about what happens if that doesn't exist when you die. Is your intention that you want to give your house, but if you don't have your house, they don't get anything? Then that's what you need to say. If it's, I don't have my house, but I have an account that you can trace the proceeds to, that I want to give that, you need to say that, because the way the laws around a will says, if you don't say, then it's gone, the gift is gone. So you need to make sure you say what you want to happen. Another way to do it is a percentage or a share. That way it's kind of easier, because it's just a portion of whatever's left at the end of the day. You can think of it as a percentage. When we draft, we usually say the word share, but it's the same idea. And then sometimes we do a mixed one. So you say 50,000 or 1% of my estate, whichever is less. We do this in circumstances where usually people are a lot younger, so we have no idea how much they're going to have when they pass away, because their estate can grow and shrink. So what we usually do is we look at their current net worth and how much they would like to give if something happened today. And that's how we get the percentage. And that just makes sure that if they want to give $50,000, there's only 70,000 left at the end of the day, the charity is not going to end up taking the bulk of the estate. So the best way to do this is to contact a lawyer to ensure it's drafted correctly, to make sure the charity is named properly, and that the charitable registration number is put on there. I always do that just so there's no confusion of what charity I'm talking about. And there's also a side praise clause, which is just Latin, and it's just confirming that, say the charity changed its name, or maybe they amalgamated, that your intention is still to give that gift. And if it's not that, then we need to say that as well. So again, just confirming what your instructions would be. Outside of a will, you can name beneficiaries on certain products: life insurance, RSPs, tax-free savings accounts, segregated accounts, pension, death benefits. You don't have to leave it 100% to a charity. You can leave us a certain portion. If you want to do something complicated with your beneficiary designation, you're better off doing that with your financial planner and your lawyer together, to make sure that if their form doesn't work, that you can do what you want to do. And my last little note is, if you're thinking of leaving something to a charity and you want something specific with that gift, so you want it to go to a specific program, it's really better if you talk to the charity first to make sure they can use it, and that that program is going to be long term. Because if you want to leave it to a specific program, but you pass away in 20 years and that program doesn't exist anymore, it makes it very difficult on the charity. So have that conversation, plan. Thank you.
Thanks so much, Jennifer. The way you describe things, it makes it so much easier to understand. And some of your points are really thought-provoking. Vuyani is going to take a bit of a sidetrack to explore cryptocurrency. This is a confusing field to many of us, and there's so much conflicting information that I'm sure we're all curious to know more about it. Vuyani?
Thank you, Mepeg. Hello, everybody. I am simply going to just break down what this whole cryptocurrency is. I know that a lot of people find it quite overwhelming in terms of just understanding it. And I think the best description that I got earlier on when I was trying to understand it is somebody took me through just an analysis, and they said that you have to look at cryptocurrency as a different form of payment, right? And what they mean by that, when you look at the journey that we've gone through in terms of transacting, right? Historically, people would be trading, goods by a bartering system. Then we moved on, and we moved on to saying that we're going to trade with gold and coins, silver. And then later on, we moved and said, no, we're going to transact with paper, right? And so right now we've gone into a phase where we are transacting through a digital payment method, right? And so I look at this whole cryptocurrency movement as the way, as a journey in terms of how people transact. Same way that music has changed. I always give the analogy that when people started, my mom and her generation, they used to listen to turntables. And then my generation was listening to cassettes. And then my younger brother, they were listening to CDs. And now my children just stream the music from some cloud, right? So that is what's happening with cryptocurrency. So let's just go delve deeper into exactly what it is, right? In its the most simplified manner, they call it a medium of exchange, which I've just talked about, which is stored electronically. We know that we've moved into an environment where everything is starting to be done with technology, right? Same with digital currencies. And in fact, it's interesting because you're seeing a lot of countries right now starting to talk about creating an alternative currency to the normal currencies. So the dollar, we're hearing about a digital dollar. The Chinese yuan, we're hearing about a digital yuan. South Africa is talking about it. We know that the Caribbean has actually already come with a what they call the sand dollar. So I think it's going to be something that we all have to sort of come to grips with. Now, interestingly enough, with respect to philanthropy, there's a couple of research and reports which have come out to say that crypto has boomed in the last 2 years in terms of contribution towards crypto philanthropy, right? Where people are giving in crypto. And you'd ask why, what's the extent of this? Literally, Fidelity, for instance, reported that the crypto given that they got over the past year was around $330 million, right? That was up by over 1,500% in terms of the given that they'd gotten in 2020. And we see these trends coming through. And so where is it coming from? Who's using this cryptocurrency? We found that usually it's been younger generation because they're more embracing of cryptocurrency. However, I think that there's also, I'm seeing traces of older people as well, mature people like ourselves, who are getting into cryptocurrency and trying it out. So let's just understand the landscape of cryptocurrency. I always say, if you want to understand cryptocurrency, you have to almost equate it to what you're familiar with. The way that money is right now, right? So we are familiar that we've got the dollar, the rand, Swiss francs, you name it. In cryptocurrencies as well, we've got different forms of cryptocurrencies, right? There's what's mostly known, Bitcoin. Bitcoin is a large part of the market cap of crypto, and you'll see that it's around 50% of the crypto market. There's other cryptocurrencies, Ethereum, there's Tron, there's so many of them, right? And they each serve a different purpose. It depends on what it is that you're trying to do, how quickly you want your transactions to happen. But generally, there's a lot of cryptocurrencies, just like we have a lot of currencies that we know, which are related to our countries, right? These ones are related to a particular use case, and we'll just get into that. So why is it special? Why do people like cryptocurrency so much? It's a number of things, right? A lot of people highlight the fact that it's got increased transparency. You can accurately track when payment has been made, where it went to, when it got delivered. You're able to see everything. Where do you see this? You see it within a ledger. So think of when you're making payments, you've got your own physical ledger where you know that there's payments, there's receipts, and there's payments that you're making, and you can look at it. Within a cryptocurrency, they record all the transactions through what they call the blockchain, right? And I'm just breaking it down. And what is the blockchain? The blockchain is literally a digital ledger which records all of the transactions which are happening, right? And these transactions are recorded by the use of a number of different computers which are all over the world, right? The difference with cryptocurrency versus our normal currencies that we know is that cryptocurrency is not controlled by any central government, right? So our dollars, it'll be, the Reserve Bank. South Africa, it'd be the South African Reserve Bank. In the US, the Fed. But in terms of cryptocurrency, it is not controlled by anybody. And so typically what you're finding is that these people, the computers which are actually validating and looking at these transactions are the ones which actually serve as that backbone of ensuring that they are verifying that transactions are good. So you will see that there's different ways of how people verify these cryptocurrencies. I'm not going to get into them, but basically these computers, sometimes they compete in terms of having to solve a very complex mathematical equation in order for them to verify that a transaction is real. That's what happens with the likes of Bitcoin. And the more common one right now, which is widely adopted, is what they call the proof of stake. Proof of stake is literally that people who've got more of these cryptocurrencies and they remove them from the market are able to actually verify more. What I highlight with crypto is that just like you are careful with your normal money, where you don't give people your PIN number, you don't give people access to your bank account, the same is true with cryptocurrency as well. Typically, when people have cryptocurrencies, they are either storing it in two forms. It's either it's in what they call a custodial account, or they're storing it in a non-custodial account. Custodial means somebody else controls that money for you, like an exchange. Everybody knows Coin, Binance and the likes. You can go to an exchange like a Gemini in the US and you can buy cryptocurrency from them, and you're able to see how much you've got, if it's gone up, if it's gone down, or you can actually control it in your own wallet where nobody else is taking care of it for you. If you are taking care of it on your own wallet, on your own phone, then nobody else has control of that cryptocurrency, right? So a key point to think about cryptocurrency is that it's just an evolution. There's a lot of work which is going through everywhere and it's different. I can't tell you that one country refers to it, looks at it this way. Everybody has got a different way in terms of how they interpret it. Is it an asset? Is it a security? So I'd say that talk to your advisors. We've seen all these amazing advisors who've come and talked here. Talk to your advisors and find out what the outlook or the recommendations or what the view is in terms of your own country. And I would recommend to everybody that start to try and get familiar with it, because it is an evolution. And I believe that in time we will be all paying with some form of a digital currency, either your own country denominated currency or a cryptocurrency which exists. So you can look at that, but it's something that you just have to start knowing and getting familiar with. And that's it from my side, just giving very high level. I'm happy to delve into questions and answer questions for you, or refer you to materials later on. So just feel free to let me know if there's any questions that you have, because I do know that it's quite overwhelming.
Thanks so much, Vijani. It is overwhelming. There's so much terminology, and that was a really wonderful 101 on the subject. And because cryptocurrency is increasingly an option in our donations, we recently, Help Us Sutu recently set up a new platform called Giving Block that allows Help Us Sutu to accept cryptocurrency donations. It's fast, it's easy, and can be done directly on our website at helpussutu.org/crypto. That's on the website if you need it. These are quick but interesting presentations that bring lots of questions, lots of points. So let's bring back all of our panelists for a bit of a group discussion, see if we can dive a little bit deeper and peel the onion a little bit more into these challenging and often overlapping subjects. So can we start with you, Vijani, as you were the last presenter, and the value of cryptocurrency has declined significantly this year. So what do you think that means for the future?
I mean, the way that I look at cryptocurrency is that it does go through cycles. But remember that there's two types. There's cryptocurrency, which is stable, which does not go up and down. And there's cryptocurrency, which goes up and down, right? I think for people who are into the cryptocurrency world or scene, they are looking at this. They follow the old saying that we've always heard from Warren Buffett, that you want to get in when the fear is high, and step out when the greed is high, right? And so a lot of people right now are looking at like Bitcoin and saying, hey, this is possibly an opportunity for me to come in because I missed it last time. Remember that it's gone from $65,000 to now around $20,000 a Bitcoin. So some people are looking at it as an opportunity. I say that if you're going to get into cryptocurrency, have a long-term view, because you will see volatility with those cryptocurrencies which do go up and down, which are, so great opportunity right now, but do your homework. We do your research to find out why you're buying that particular cryptocurrency.
Charitable. And similarly, Brent, people are concerned about the value of their stocks with the economy now. Do you have any advice to share on that one?
Oh boy, that's hard to do without the detail of an individual client. But I would just similarly into the Warren Buffett kind of view. I think times like this, as it's related to giving, at least, it's important to review one's plan, right? And to say, okay, where am I at? Am I still funded? Do I have enough money? If you do, I think you could still look at your shares that are in an appreciated state. Like you heard earlier, you don't want to give anything that doesn't have a gain on it. Otherwise, there's no value. You might as well just give cash. But you can still give if your plan is funded. If there's positions that have dropped significantly and you still believe that they're high quality businesses that you can own and collect the earnings from for a long period of time, then either the charity can continue to own them or you hold them and wait till they recover again. But I do feel that, just broad brushstroke talking, that this correction feels very different than the previous sort of 2008 and 2020, where it felt like you were looking into the abyss of who knows what kind of company is going to be around when the economy shuts down. This feels more like an adjustment to new inputs of higher inflation rates, higher interest rates. And when you discount companies back to present value with those new input variables, the prices, I don't like them going down, but they make sense at the valuations that we're seeing now. And that gives me more comfort to say that this is more of a business cycle type of move that history would tell us we will get through again.
Well, that's reassuring.
For what it's worth. We don't know in the short, we don't know when, right?
Jennifer, do you have any thoughts on that scenario?
I think it really, goes back to the theme, I guess, for tonight, is the planning, and being able to plan what you're doing and making sure that you're talking to your advisors and the people when you're making a big decision about donations and when you're giving it and what you're doing with it, and make sure it's at an opportune time. Like there's people who are 80 or 90 and they've had a CP rail share since it was $1. It's not going to matter much what's going on right now. You're still going to have a massive gain on it. So it's really knowing what you have and what you want to do, and having the right people to talk to help you bridge that gap from between those two things, because there's always a way, and you just need people to help you make sure that you're being tax efficient and things like that.
Mm-hmm. Absolutely. Thank you. And one question that you could all pitch in on is one that Brent alluded to, and that it's a dilemma for people to know whether to give their money to their children, their grandchildren, charities while they're still alive to see the money being used, or whether it's more advantageous to wait until after they pass away. So Brent, do you want to chip in first on that one?
Yeah, sure. That's a really big question, as you know, right? But it's a fun one, because as planners, what we invite people to do is to, sit and talk about their family. And I think a big part of it comes down to what's the health of the family and what's the communication like. What are the kids like? Are they capable of managing money? But I know there's an increasing amount of people who are interested in having those discussions to make sure that they pass on the philosophy of, where did this money come from? How did the family earn it? How do we give? And how do we pass those part of that gift, or passing on the wealth is passing on that type of thinking. And if they do it early, there's some tax advantages, because you're spreading it out over time versus typically highest marginal tax bracket in an estate. And you get the benefit of actually watching your heirs use the money and benefit from it when they're younger and maybe in more need of it, when they still might have debt to pay off, or you can come alongside them and train them how to give and the ways in which you do all of those things that you've maybe done yourself. So yeah, if it's a healthy situation, I love having those conversations with people about how they could do it sooner rather than later.
Mm-hmm. There's a big variety on how comfortable families are in talking about those things. Patricia, Jennifer, do you want to pitch in, Jennifer?
I think there's a lot of opportunities to do things, and there's a huge spectrum to do them on. So one is just you flat out give the money, no strings attached, and it's fine. But some of the things you have to realize when you're giving to your children is, when you give through an estate and when you give personally, it is actually slightly different. In an estate, there's a general clause in the will that says this gift is for my child. And if they later get divorced and keep it separate, it doesn't go to the divorcing spouse. When you just gift money or you buy a house and it becomes the matrimonial home, you have other things you need to do to protect yourself. So again, plan. Make sure you're talking to someone that we can protect you and protect the family. There's also trusts you can set up, which might give you that added protection and that added control. Instead of just giving all the money at once, you could create a family trust and be the trustee of that. And so that then you can maybe skip some probate and things like that as well. And you might be able to include the grandchildren in there. Be careful of TOSI rules, I'm sure Patricia's going to say. And then the other things to be aware of, I think we just saw a huge thing with what's the company, Patagonia or whatever, the guy who, yes, he just put the family corp, and that the planning there, like I would have loved to have been on that. That would have been just really neat to do the way they structured it. And you can structure things like that in Canada as well. You can put a charitable trust in charge of the company and strip the profits out through the charitable trust for forever. So if you've got a family business and the family doesn't want it, but it can run on its own or with a CEO and not you personally, you could think of doing that kind of planning too. And that would just be amazing.
Yeah, that was fascinating what he did.
Yeah.
Patricia, do you want to encourage us?
Well, Jennifer and Brent have covered such, many of the topics I was going to bring up, but again, you want to have those discussions, and this is probably what Jennifer would say. If you're going to transition your wealth, I think it's valuable to have the conversations up front. I mean, there might be some family reasons not to, but if they're not, you'd want to say, sort of be very transparent with how certain assets are going to be transferred. I think the family cottage really poses a lot of issues for people. And so that's something to really talk out and account for in your will, because it's not going to happen. You don't want to leave these items for your executors to deal with and possibly not to carry out your wishes.
Exactly. One of my fears is leaving any kind of mess for my children. Have it all planned out. And as we go into, let's keep going. That's what we want to get to, the questions from our listeners. And you're a wealth advisor too, so just pitch in anywhere you like. So this is one of the questions. One of my elderly parents has not made a will. They avoid the topic like the plague. Do you have any tips for now? How I can approach this topic with them? I'm worried about their desires not being fulfilled and a giant mess to take care of.
So there's two different ways you can convince people to do things. One's positive reinforcement, one's negative reinforcement. Positive reinforcement would be maybe give them as a Christmas gift a will. So talk to a lawyer and see if you can prepay it for them. And then if they're like a lot of my seniors clients, they don't let anything free go away. And so then they'll do it because it's paid for. And then the negative reinforcement, you can say to them, look, I know it's a hard conversation, but you not doing this is going to be harder and worse for us than what you're going to have to go through to actually do it. It is a bigger pain to deal with someone's estate when there's no will. It takes more time, and as a lawyer, I can tell you my legal fees are more because it just takes more time for us to be able to do things. There can be delays with the courts and getting things done. If we have non-residents, it's even more complex. If there's children under 18, it becomes a bigger pain. I can list off a million reasons why you should do it. Everyone knows why they should. I think what you have to realize, though, is that 60% of Canadians don't have a will. So this elderly parent isn't out of the norm. But there's a generational thing and they don't want to talk about it, don't want to address it. They're like, I'm gonna die if I do this. Yeah, exactly. I hear that all the time. I'm like, you're dying anyways, you might as well make it easier on the people you're leaving behind. But I have found that if you give it to them as a gift,
that's a great idea. And
you're not gonna let that gift card go unspent. So
you also mentioned giving that as a gift as a wedding present before.
Yes.
Talking. I love that idea. And also you want to minimize the conflict among the children. Yeah. We've all seen disasters in that regard. Thanks so much. Patricia, do you want to tackle this one? Could you speak to the benefits of giving a life insurance policy to a charity while the insured person is still alive versus directing the gift after death?
Yes, there's actually, so it goes back to the idea, where is the tax liability and which one do you want to eliminate? Because you can structure this plan in two ways. You know, if you want to have the donation in your estate, then you would just simply name the charity as the beneficiary of your policy. If you want to have the donation credits during your lifetime, then you would look to have the charity becoming the owner of the policy and the beneficiary of the policy. And it can be done two ways. You could donate the current policy, although you'd have to look to see the tax implications. Again, talking about the fair market value versus the ACB, there could be a tax liability there. Or there's the other way of curating a new policy, and whereby the charity is the owner and the beneficiary, and you pay the premiums during your lifetime. So that's an annual, you'll receive an annual donation tax credit for the premiums paid.
We have a donor.
So again, follow the tax. That's what.
Yeah. We have a donor who does that. So that's her annual donation, is the premium of the policy. The setup for us, and when she passes, it goes to us.
Yes, and then it's an excellent for the charity, because it's quite, you know, the death benefit is going to be much greater than the policy premiums paid.
Exactly. It's a very smart move. Vuyani, is it, you know, a lot of people, you were mentioning some of the people who bought crypto just possibly when it was next to nothing. Is that a good idea to leave some of these crypto in your will?
So I think it's an asset, right? If it has grown, you want to have planned for it to know what happens once, you know, you've passed on. And the reality is that a lot of people, if you don't plan for it, then it'll disappear. It'll be drifting somewhere there, right? It's almost like money where nobody's accounting for it. So I believe that it's important to always communicate and ensure that you've written down exactly how people should access it, and they should know exactly how it should be transferred from one person to the other. And just adding on to what everybody has said, in terms of children, younger people, I always highlight the fact that in the end, a person needs to make a decision about whether or not you want to leave your family better off or not, right? And the key reason for why most of the time wealth transfer fails, according to a lot of research, is really around lack of communication. Lack of communication amongst family members about what's going to happen, lack of communication in terms of communicating and ensuring that the next generation is ready for that. Lack of communication in terms of giving everybody a knowledge and understanding of what the implications are when they do receive whatever it is that you've left. So the best thing to do is always communicate and to always plan. So I'm a big, strong and a very strong believer in saying that utilize your service providers, use your financial advisor, your tax advisor, your legal advisor, ensure that you have planned, and over and above that, make sure that you're educating those people that you're going to be leaving everything with.
That's great advice. Thank you. I'm sorry we don't have more time for questions, but we promised this would be over at 8. And I know that I'm going to be sending the email with the webinar and the notes to my children and my friends, and you're probably thinking the same thing too. It's a great introduction to the kind of conversations that you've all been talking about. So thank you to Patricia, Brent, Jennifer, Vuyani. This has been a great hour. Brent, Jennifer, and Vuyani have agreed that you can contact them afterwards to avail yourself of their professional expertise, if that's helpful to you. We've all worked hard to build up our resources. The needs are everywhere, and we want to make sure that we're doing smart giving. Thank you for joining us. We hope this session has addressed some of the issues on your minds. Let us know. We love feedback. And if we can help you in any way, please reach out. Our staff and panelists join me in wishing you all the best with your decisions, your deliberations, and your discussions. Until next time, bye-bye.